Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today, the focus is going to be on covered calls, and we're going to be talking about how a trader might scan for potential covered call trade candidates using thinkorswim's Stock Hacker tool. Should be an interesting discussion. We'll talk about the sorts of characteristics in a potential covered call that a trader might be looking for, and then how we might go implement those into a scan and find and place some trade candidates. So a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see Marcus and Josh, Tony P, Will, Debbie, Lawrence. Who else is here? Kevin, Eva, Greg, on and on the list goes. As always, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. That's a great way to watch these webcasts. But be aware that you're invited to join us in the live stream. And if you'd like to be here, this is a Monday webcast series. We kick things off promptly 2 Eastern time. Now, I also want to let you know that my very good friend Barb Armstrong is hanging out in the chats with us today. She's going to be keeping an eye on any questions that come in through those chats. If I can't get to those as I'm doing my presentation, Barb's there to pick up my slack. Thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to everybody listening. Please follow us on social media. You can find Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS, so find and follow us there. But you can also now follow me on LinkedIn. You just go to linkedin.com/in, throw on a Cameron May CS. That's my handle. That'll take you right to my profile. You can give me a follow, and that way we can interact in between the live streams when the camera is not on. But let's get into this discussion of scanning for covered call candidates. Of course, as we do this, that approach involves risk, as does every other approach to trading and investing. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about covered calls. Here's the agenda for the day. Of course, as we always do, we're going to look at existing example trades first. We have a number of them in our example portfolio. So we'll go look at those, and I think there's one that needs some attention today. Then we're going to look at what's going on with the markets. And this is going to kind of inform the approach that I'm taking today. Sometimes I'll do short puts, sometimes I'll do covered calls. We look at the markets first to decide between those two. So we'll talk about the S&P 500 as that sort of a backdrop. And then we're going to find and then plan in place a covered call. So I'm going to talk through what are some of the characteristics that a covered call investor or trader might be looking for in potential candidates. How might they create a search for precisely those characteristics? And then we'll build and place that example trade. There we go. So let's go right to it. So JDLMI says, Cam, did you ever do a class on scanning for selling puts? Can you share that one? JDLMI, since the strategy is so closely related, actually, that's a great question. And this is a great point that I didn't even think to bring up. But yeah, same scan could conceptually be used for either one. All right. So, but in any case, let's go to it. Let's go have a look at what's going on with our example portfolio. And I'm still doing well. I mean, it's a bullish market. We're trading bullish strategies. They're doing well. Not every one of them, though. Actually, one of them has done a turnaround today, so that's nice to see. But first of all, we have Apple. We sold a 265 put. The preference here for the trader might be for the stock to be above and to stay above 265. If they get assigned, they might have to decide what to do with the shares from there. But right now, let's see what's going on with Apple. So we sold our puts here. Break even is down at 260, 223. The stock was initially cooperative. It's been pulling back. I think it's kind of interesting that this recent pullback has taken us right down to an upward sloping trend line. We'll see if that holds it as a new price floor. It's not guaranteed that it will. But if we do pull back and we fall down in the range of 265, or if for whatever reason someone gets a wild hair, we get those shares assigned, we might take a look at maybe selling covered calls in that case. Otherwise, if this just expires worthless, we'll move on to the next one. All right, but this one is actually doing fine. 4 days till expiration. We're going to leave that one alone. Still about $9 out of the money. So our Amazon position is another short put, sold 2 contracts, so the 215 puts. We'd like for the stock to be above 215. It is. It's at 223. Barely at break even right now, though, and this is why. Let's go look at Amazon. So with Amazon, this was last week's trade. Let me put a little oval around the candle for last week. This is when we were talking and we placed that trade. So initially we got a little bit of a bump. It's actually sold off now, but time decay has made up for the incorrect price move, so that we're still just slightly above break even on this trade as of this moment. When you see these break even numbers displayed on my screen, that's break even at expiration. Those break even levels can certainly fluctuate before expiration because of time element. Noodlebrain says, is it better to take assignment or roll out and down? Well, better or worse is always defined by what happens next. It's what happens with the unforeseeable. So we don't know, right? If assignment appears imminent and the trader thinks, well, if I get assigned those shares, I think those shares are going to go up. If they're right, then allowing the contract to be assigned might have been the better choice. However, if assignment happens and we think the shares are going to go up and the shares don't go up, they go down, maybe that wasn't the better choice. So it really is extremely contingent on what we don't know yet. So we'll take a look at it though and talk about, as things unfold, we just talk through the realities of what's happening at that moment, and we talk about potential management from that point, okay? But for right now, these contracts are well out of the money. Could still be assigned, but that would mean somebody's selling us shares for way less than they're worth, which would be great. It's probably not going to happen. But our break even at expiration is 211.30. We will also consider selling covered calls if assigned. Now, the reason why we wouldn't just do it is if the trader has become convinced that the stock is just going to continue heading down. Selling calls is just slowing the bleeding. The patient's still dying. If you can forgive that analogy. Anyway, so Mark says, all right, yep. Anyway, thank you, Mark, just for commentary going back and forth between attendees. Amazon, we're going to leave alone. Bank of America, we own 200 shares at $50.58. Right now, we have an obligation to potentially sell those shares at $54, and that thing's in the money. So the stock is at $55.40. Looking like assignment is, I don't know if we're going to call it assignment risk. The probability of assignment is high. I don't really define it as risk, because what this means is if we're required to sell the shares, well, we bought those shares for $50.58. Selling the shares at $54 would be a realized gain on the stock, plus the incomes, there's been multiple, that we've collected along the way. So that would be a profitable exit. Anyway, so this is our Bank of America position. Let's look at that. So we bought those shares back here, $50.58. If you ever want to see the logic of the initial trade, you can just go to the archives of this webcast series. So do this as a favor to yourself. Make sure you're subscribed to our Trader Talks channel. You can click on the subscribe button right down below. It only takes a second. It doesn't cost anything. But this is where you can join our live streams that we have each day of each trading week. Or you can find the playlists of previous webcasts. So if I go to playlists and I scroll down below, we're looking for trading covered calls and short puts. There it is right there. We click on view full playlist. And right here are the archives of all of these trades. Right? So you can go back and watch those and see when we're placing those. But I try to make the logic obvious with my drawings here on the charts. So if you're wondering where this text and these lines are coming from, I just draw them on there. Okay? So we bought the shares for $50.58, Bank of America, sold into a contract, obligating us to maybe have to sell the shares at $51. That contract just expired worthless. We have a realized gain of $107 there. We have another realized gain of, or those contracts, I should say, 2 each time, collected $1.27 in realized profit there. So we're up about $2.34, setting commissions aside, per share so far. And then we also have 47 additional pennies, 47 cents collected. If we get assigned, that would be a realized gain, not quite $3 on the options and a little bit more than $3 on the stock if this most current contract is assigned. We'll see. We might pull back here and get back down below 54 and see this expire worthless. What I do know is that early assignment doesn't happen in paper. It can certainly happen in real life, though. All right, so let's go to the monitor tab. Let's let Bank of America work. So those first three doing just fine. Our Alphabet is doing great. These are shares we purchased some time ago. We just let them sit there in the account. It was actually sitting down in our unallocated portion of our portfolio. And I decided essentially to call it up. Let's add this to our covered calls discussion. So we sold some calls against that. So right now, we're obligated to potentially sell these shares that we purchased for $199 for $315. So obviously that would be a very large realized gain. That's why we're seeing a really big number right here. And we've also collected a premium. So here's what's going on with Alphabet. Shares purchased back there. Sold this call right up here. This one's now gone out of the money. So assignment risk is reduced, still possible. It's reduced. We are looking to, if we're not called away, if the stock just continues to fall, well, we'll just probably decide to close the trade right down if we break down below that most recent resistance. Otherwise, if it starts to climb again, we'll see what happens there. But that's doing fine. Microsoft sold a put. This is our long-term trade, still 767 days left on these contracts. Sold the 380 put with the stock trading closer to 480, 475-ish. So here's this one. We sold the puts right here. And what we're hoping for, what the trader is commonly looking for when they sell a very long-term option, is for the stock to move in a good direction and allow maybe a quick exit. We haven't really gotten that yet, but we still have 2 years. So what we'd like to see is for the stock to start to climb, putting this contract even further out of the money, maybe accelerating its decay. We'll see if we, not this one, that's the break even, this one. But this one, we'll just let it continue to work. Nvidia is a covered call. This one I think we need to do something with, because we sold a premium for $350. It's only about 7 cents of value remaining in that. 4 days left till expiration. We could just let it expire. It's very likely, high probability this just expires. But let's see what's going on with Nvidia. We've sold the 195 call. Here's the history of Nvidia. And by the way, note overall, it looks like this position is down about $311, and that's not including a $350 realized gain we already have on Nvidia. So we're actually a little bit above water on this trade net. But if we go look at Nvidia, bought the shares here, sold a November call. That one expired for a 340. I think I said 350, 340. A 340 realized gain there, setting the initial commission aside. We've sold another call at 195. That one's way out of the money as we get close to expiration. That's why it's only worth about 6 cents. I think with this one, let's see if maybe we can close that out for 6 cents, possibly roll up. Can we get back to the 195 call for the next expiration cycle out there in January? I'm going to see. And it looks like there's a survey that's been posted. Great. I'll get right to that. But how about let's do this trade first. Let's see if we can close out this current call for a few pennies. And see if we can sell another 195 for the 16th of January. I don't know how much those are worth. Let's go look at them. Look at the trade tab for Nvidia, 16th of January. 195 calls. All right, they're worth close to a couple of bucks. Anyone that has the minimum 1% return, that would meet that objective. Not everybody has that rule, but I'm going to go ahead and do that. Let's sell the 195. So here's how we might roll. And a roll just means we're going to close up one trade, use that same order ticket to get us into another trade that's on the same security, but that's it. So here's our 195 19th of December call. I'm going to right click on that and create a rolling order. And this will describe this as a calendar, but it's actually just in order to buy back the 195 for the 19th of December and then sell the 195 for, let's go to the 16th of January. And it looks like we might be able to get a credit somewhere between $1.87 and $1.89. Let's back off on that. Let's say we'd even settle for $1.85. Giving up a few pennies in the interest of potentially getting a quick fill while the camera's on. It's not going to slow us down, hopefully. Even, oh, look at this. It shifted on me. Even when you think we're being generous, there's not a guarantee that order is going to fill. I might even need to back off on that a little bit more. Let's go down to $1.83. In any case, let's click confirm and send. We're attempting to sell, that is sell a calendar, but basically buy back the 19th of December call, sell the 16th of January, hopefully for a net credit of at least $1.83. That would be $183 minus the commission to get out of one into the next. Minimum acceptable credit for this trade, $181.70. So let's click send and see if that'll get filled. And it did. Okay. So we filled that for $1.86, probably out for a few cents on the one that we're in for about $1.90 on the other one. So we have new profit potential, but also a new obligation. Our obligation is just extended further out. So I'm going to draw in a line here, referencing that new obligation. It's now going out here. There we go. I'll come in and clean that up after the webcast is over. But let's throw out the reminder now, though, that there is a survey link that's been added to the chat window for those that are here in the live stream audience. So for my live stream audience members, if you would do me this favor, click on that survey link right now. It'll pop up the survey. You can just push it off to the side and then just fill that out when the webcast is over. You can give me some honest feedback. You should know that those surveys are really short, 2 multiple choice questions. There's a comments box and a suggestion box, but that doesn't mean they're unimportant, because when you fill that out, they send that information right to me, and that data helps. The comments help. I read through it all. Definitely helps. Okay. Let me see, a question just came in. Okay, thank you. Anyway, no, that wasn't a question, just an observation. All right, anyway, back to our portfolio. One more position left to go through. XOM, I don't think we're going to be doing anything with this today as a spoiler alert, but we bought 100 shares. We sold the 120 call. The stock's at 117. So kind of, it's below our strike, but above what we paid for the shares. So that's pretty much what the covered call trader would be looking for. Let's look at that. There's XOM. So we purchased the shares here. Shares were doing really well. Came right up there. We're teasing right at our strike. But boy, it's been a rough day for Exxon today. We have a plan. If this horizontal support, most recent price floor, breaks, we might consider selling those shares, getting out of the call, and wrapping it up. But we're still above trade break even. And for this one overall, up a little bit, 88 bucks. There we go. So those are our current positions. We're going to be adding a new trade now, but I want to talk about why a trader might be looking at covered calls. Not everybody is, but there is a certain market condition that for some is sort of the reason why they might start looking to covered calls instead of maybe something like just buying the stock. Then we're going to run a search for potential covered call candidates, just as an example, and then we'll place a trade. So let's go have a look at the SPX. Let's see what's going on with the stock market. No surprises to anybody listening probably is that the stock market has been very bullish. We're still only trading maybe 1.5% below recent highs, 1.5%, 2%. But what is potentially notable for some technical traders is that it's now been 2 months or so that stocks just really haven't been able to advance above those highs. So a bit of a struggle here. Now what that can do is cause it. Now, if we're a long-term investor, it may not matter in the slightest. But for those traders who are waiting for shares to appreciate, it hasn't been able to do much of that over these last 8 weeks or so. So when appreciation isn't being delivered, what some will do is they'll look to something else that their shares might do for them, like maybe generate income. Now, income is, even if collected, there are, as we've learned, obligations that come with doing this. But yeah, at these sorts of market conditions, for some traders who use the charts to gauge when to enter their covered calls, this is fairly typical of when a trader might look to sell a covered call, when they don't think stocks are going up anytime soon. JR99 says a recommendation on how to exit a cash secured put when the market goes down. Well, I can't tell you about your situation specifically, but I can say generally, a cash secured put, a covered call, stock ownership, all of those have a lot in common. And that is that strong downside risk. So if the trader has concluded, boy, the stock just is selling off, it's breaking support levels, the sector's moved out of favor, the company's not well managed, whatever their logic is to say time to get out, it might just be time to get out. Now, I know you're probably looking for something sexier than that, right? Ooh, isn't there something we can do like salvaging the trade or repairing the trade, saving the trade? What are some other words that are commonly used? Yeah, those sorts of catchphrases, those very eye-catching phrases are typically used by somebody trying to sell something. Yep. Attempting to repair a position that has already gone south actually does nothing about the fact that it has gone south. What it does is it's an effort to stack on additional risk or to shift the risk in the hopes that it then course corrects. Anyway, just know that salvaging a trade doesn't actually change the past. What it does is it creates a different possible scenario for the future, but the future remains unknown. Anyway, I know that's kind of high level, not very specific, but I just thought that was a good question. There's a quick way that I would address that. But let's get to looking for covered call candidates. Now, before I look for covered calls, maybe before the trader just goes and runs a search, maybe they ought to define what it is they are looking for. And there are some common threads that typically run through a lot of covered call traders out there. Not every single covered call trader is going to agree with this little list that I'm about to put together, but I think a lot might see some familiar priorities. So what are some things that a would-be covered call income trader might be looking for? Well, number one is just applicable to options traders in general. That is, liquidity can be a high priority. I get questions about this all the time. I got a question in my YouTube comments just today about illiquid options. But the fact is that when trading options, if we're trading options on illiquid stocks, the options tend to be even worse. That shows up in pricing difficulties with wide bid-ask spreads for the options trader. That can apply to covered calls as well, making it difficult to get into these, difficult to get out. So liquidity. I'll talk about how we might address these things, these priorities. But number two is affordability. When we're trading covered calls, we got to buy 100 shares unless we're trading some non-standard contracts. But for standard contracts, it starts with the purchase of 100 shares. And if the shares are high priced, for some budgets, it's not going to fit. For others, the high prices are not a problem. But yeah, that price could be a concern. Now, number three is other sources of potential dividend, other sources of potential income in the form of dividends. Now, not every covered call trader is going to be looking for additional sources of potential income because there can be a trade-off. Stocks that, for example, pay dividends also tend to be a little bit lower volatility. That might mean that their options are just not as high priced on average as non-dividend paying stocks. Now, that's not universally applicable, but for some, they might be looking for, okay, income from selling calls, also that possible income from dividends. So I'm going to throw that on as our list of priorities here. And then finally, even if the stock is comparatively liquid, even if it fits the affordability demands for a given portfolio, even if the company is paying or has been paid dividends. And by the way, got to throw out this reminder, dividends are not guaranteed. They can be reduced or discontinued at any time. It's up to the management of that company. But even if those first three criteria are met, if the stock just continues to sell off, for some income traders, they might see that risk of capital depreciation as outweighing any offer of potential income, and they skip it. So let's say price performance. All right, so let's say this is a short list of potential priorities for our would-be covered call trader. Let's go plug those into a scan. How might we look for liquidity? Well, a quick way to do this, and by the way, if you've never used the Stock Hacker scan tool, I'm actually going to switch over to our live platform, because this last one is going to require a search metric, a scan metric that's only available on the live platform. Now, when I say live, it's still just a fake live account, but this is not a true paperMoney account. Okay, paperMoney account doesn't have the one criteria that I'm going to be demonstrating here. But let's go to the scan tool, and we're going to be using the Stock Hacker here, and let's plug in those 4 priorities. And they are just example priorities, but first of all, liquidity. Liquidity is never guaranteed, but one way to move the probability of having liquid options is to look at the market capitalization of the stock. Market cap is just how much the company's worth as determined by price per share times the number of shares. And let's say that we put in millions of dollars, let's put in 100,000 as our minimum requirement here. What this is saying is this trader is looking for stocks that are worth at least $100 billion in market capitalization. Those are some of the largest companies on the globe. So those are going to be among the most liquid. Now, next up was that affordability metric. Now, each trader is dealing with their own unique portfolio demands. But let's just look at the last price of our shares. And let's say, there it is. Let's say that our trader is okay with stocks priced between $40, which would be a $4,000 purchase for 100 shares, up to, I don't know, it's going to vary from one to the next. Let's go up to $300. That would be a $30,000 investment in just one stock in order to sell covered calls on that. Third item was dividends. So let's go to yield. Average yield is under 2% right now. Let's just say maybe our trader is looking for a round average to maybe a multiple of average, maybe up to 6%. Now, as I'm plugging in these criteria, over here the scan tool is showing us approximately how many companies match that criteria. So there are 350 companies that are $100 billion companies. There are 2,254 companies that are currently priced between $40 and $300 per share, and so on. So you can see what that means. Now, if I run the scan right now, we've got about 77 companies that meet all 3 of those criteria, but some of these may be persistently downward trending. Now, some traders may actually see the potential in a value in that, okay? But let's just say that our would-be covered call trader is looking for something that's been showing some recent price strength. And so I'm going to add one final filter. Let's click on Add Filter, and it's going to be a study or a chart filter. And specifically, this one relates to price performance. That was priority number 4, and I'm going to choose near high lows. You've seen me demonstrate this before, but really this is just telling the system we want our price to be near either highs in the case of, let's say the trader is looking for bullish behavior in price, or near lows for bearish behavior. So we're going to look for the current price is within, let's say, 10% of the 252 day. 252 days is just a normal trading year. That's how many market days there are in a year on average. But we're going to make sure that says high. So current price is within 10% of the 1-year high. So probably not a stock that has collapsed in price to a significant extent recently. So let's click scan, see how many of our 77 companies meet that final criteria. And it just eliminated 22 companies. So now we're down to 55. And I was looking at this list, some of which we already have positions in. So I noted, let's look at ABV, ABBV. So let's go back over to our paperMoney portfolio, which is where we house our covered calls and short puts portfolio. And I want to look at what's going on with ABV. And here's what a would-be covered call trader might note, is that the system seems to have done its job. We do know this is a stock priced between $40 and $300 per share. It's $227 and change right now. It's one of the biggest companies in the world. It's at least $100 billion in size, so its options are more likely, not guaranteed, but more likely to not have a huge spread between the bid price and the ask price and suffer from liquidity issues. Oh, yeah, somebody just asked, can I share this scan? Yes, I can. Let's come up here. Wrong one. Click this menu. Let's share the scan. And there we go. Let me just post that in the chat. And I will state, as always, shared scans are not guaranteed as to timing or accuracy. I'm also going to add that scan to my session notes. So I remember, for those that are watching on the archive, I'll put it down in the video description so you have access to it as well. All right. I'll put in language saying like, here's the link to today's scan, something like that. All right. So, but thanks for reminding me. I do have the intention when I create these scans. You can just create them at home, following along if you like, or I can share those links. One final note is if you don't know what to do with those links, once they've been given to you, you can just come up here in the upper right-hand corner, not that one, this one, this little gear icon, open shared item, paste it in here, preview, import. Oh, no, sorry. I do too many things at once sometimes. Forgive me. It's a scan we just shared, so stay here on the scan and load a scan query. Anyway, you get it. That's where you go to load it. Greg, is there a name? I didn't give it a name. You can give it a name if you load it up, if you want. In any case, let's go back to AbbVie. And a final technical observation is, yes, stock has gone up. Is it liquid? Most likely. It's a $100 billion plus company. Is it affordable? Depends on the demands of the individual trader. Does it pay dividends? As a matter of fact, there's a dividend scheduled to be paid right before expiration of the next contracts. That's interesting. What does that matter? Well, for some traders, when they're right up on the edge, they're trying to decide whether to buy our shares or not, they might decide on that last day or maybe a few days before, grab those shares so they can get the dividends. That's a consideration. But also price performance. Stock has been moving higher. It is within 10% of these 252-day highs or the one-year high, but it's recently come down, bouncing off an apparent trend line. Let's say that our trader thinks that price is likely to go up for a while, but is it possible that it might struggle again as it gets up to these previous price ceilings? Looks like there's been a pretty good ceiling, around 240 bucks. So what if, for today's example, and Myron, if you need a demonstration of how to load things, it's already on the archive. This webcast is scheduled to be archived, so you can just go to the archive after the webcast is over, skip to about 32 minutes in, and just watch that. Okay? But we're bouncing off this apparent trend line, possible support. Let's say we buy the shares, give them room to the upside to move up, and then allow, if someone else wants, maybe the trader allows them to have the right to buy their shares for $240. Or exactly right. Sessions are recorded. They can be replayed, rewound, and paused as needed. Most of them, the vast majority are. There are a couple that aren't, but yeah. All right, so that's going to be our plan for this trade. Let's go place our trade. Let's go to our trade tab. Go to the what did I say? The 240. There it is. Looks like that's trading around $2. You can see there's even a pretty good spread. $1.88 to a 231 is about a 43-cent spread on this $2 contract. Yep. Even with some of the largest companies out there, there can be wider spreads. So imagine if this were a less liquid stock, that could be wider still. But let's see if we can get maybe somewhere on the order of $2 for this contract. That'd be around 1% of the value of the cost of the trade. So let's go to the 240 strike. I'm going to right click on the ask price. And how about we do, let's do 200 shares on this one. Right click. And the trader would just need to decide for themselves how many shares they can afford to purchase. But we're going to do 200 shares here. Let's put in an order to buy what's known as a covered stock on thinkorswim. That's just their word for covered call. But let's dial this down to just buying 200 shares and then selling 2 contracts of the 16th of January 240 calls. Looks like that might cost us net about 225 bucks, maybe a little bit more. Let's dial this up, say that we're willing to spend a little bit more than just the mid price to buy the shares and collect the premium. Let's click confirm and send. We're going to buy these 2 covered calls, 16th of January 240 calls at a maximum of 225.30. If we can't get it for less than for 225.30 or less, this order just won't fill. But there is a commission to be paid on those contracts, and the net cost is going to be around $45,000. Now, obviously, that's where the affordability question comes into play for some traders, and this is where they might tweak the parameters of the example scan if they need to. If 300 bucks or 200 bucks is too high, dial that down. Okay, but let's click send. Let's see if we can get this thing filled. We go to the working orders. We're offering to pay a debit of 225.50 or 30, and that filled for 225.07. All right, great. So that is now in the portfolio. It's by default. There we are. Let's click on that, and we can see by clicking on ABBV, we can see the trade price. Paid 227.18 for the shares, received 211 for the contracts. So that's our 225.07 net cost. So from here, what do we want? Well, the trader would probably prefer for the stock to go up, but if they don't want to sell those shares, to stay just below 240. That leaves the contract out of the money and reduces the risk of assignment. Doesn't eliminate it, but it reduces it. What they do not want is for the shares to plummet in value, because we own the shares and we're taking those lumps, and $2.11 of income doesn't make up for a whole lot of downside risk on share ownership. There we go. Guys, we've accomplished it though. When I kicked things off, I wanted to talk through our current positions, but then look at the markets and do a scan for potential covered call candidates. Now, what I would encourage you to do now is, yeah, you can use my scan. It's not guaranteed, but it's not the scan for everyone. Every trader should feel empowered to modify scans or create their own scan with their specific trade priorities. All right, everybody, thanks for giving me your time today. I'm going to let you go enjoy the rest of our webcast, but I do want to make you aware of the full slate of educational resources available to you from Schwab Education. So first of all, I've already given you a reminder, if you haven't done it already, to subscribe to our Trader Talks channel on YouTube. So this is where you can join our live streams. This is where you can find the playlists of previous videos or webcasts, including this one. This one's scheduled to be added to playlists, and unless there's some technical glitch, that can happen. I don't think it has today, but you can go and look at things like there was a request for me to repeat the process for loading something that's been shared. Well, I don't need to repeat it because it's on the archives, so you can go check there. You can also see previous webcasts if you want to see the logic of trades that are in place right now in our example our portfolio. But Barb and I also want to say, follow us on social media. It's another great resource. Barb and I are both very active on X. So you can follow Barb on X at Barb Armstrong CS. You can follow me there at Cameron May CS. If you reply to one of my posts here, I try to reply right back to you. And you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. That'll take you right to my profile. You can give me a follow. And you can see things like this video I just posted about, and this is kind of proven to become somewhat popular. I've gotten quite a few comments on this, how a trader might spot a candlestick called a power box on thinkorswim with something known as equivolume charts. So I take 2 minutes and explain what a power box is, what equivolume charts are, how to load them up. So give me a follow on those two platforms. Two other reminders quickly. Anytime you enjoy a webcast, if you just click the thumbs up button, that always helps. That's like a pat on the back to your presenter. It also gives us a boost in the YouTube algorithm, helps more people find our videos. But finally, there is a survey out there that Barb has kindly reposted. So if you would just click on that survey link and give me some honest feedback, I will read through your comments. I read through that data. It's always helpful. All right. Thanks, everyone. I will look for you in next week's webcast. Now, I also have other regularly scheduled webcasts every day of the trading week, so I'd love to see you in those. I'll look for you in webcasts. I'll look for you on social media. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.